Should you worry about your bond funds? My man Russell writes in with a question. He said he just read the new 60/40 book by Tony Hillenbrand with Safeguard Wealth Management. Russell says that Tony argues that no fee index annuities should replace the bonds and CDs in the 40 part of the portfolio. I would appreciate your thoughts. Let me get Finney out of here. Hold on. All right, so I don't know the slightest thing about this book. So let's look it up, shall we? I don't know who this guy is. He might be the next Warren Buffett. I don't know. But the new 60/40 portfolio, how the next generation's retirees can achieve radical financial freedom through better safe investing. All right. It came out August 30, 2020. And let's see what we got here. The results, Warren Buffett. Let's see. How a 6% rate of return is better than the 8% return in retirement. How to get Jeff Bezos, Jamie Dimon, and Warren Buffett on your payroll. Why 3 PhDs argue that the 4% rule is broken. Are we really using this appeal to the PhD thing? No, there's a couple. Oh, my goodness. Oh, no. The better safe investment that beats bonds, CDs, annuities, and gold, according to 5 PhDs, 2 Nobel laureates. Oh, boy. So I'm already not, anytime you start using this appeal to authority, have you never heard of long-term capital management? And he's talking about Ibbotson. I don't even think Ibbotson is Roger Ibbotson a PhD. Talk about fixed index annuities. They'll be a better alternative than bonds. I disagree. I mean, it could be. I don't know, but I'm not a big fan. Anyway, let's just look at. So you got 6 reviews. Let's check out some of these reviews. See what people are saying. We got. I can see a couple of things I don't like actually on the reviews. Well, 2 things I don't like. None of them say confirmed verified purchaser. That's not good. I also don't like it says October 2020, October 2020, October 2020, and October 2020. So we have none that are verified purchasers, and they all in October had written the same review around the same time. I don't like that. I'm not here to bash this guy. I don't know the first thing about him. Don't know the first thing about the book. The propensity to use a PhD stuff actually just drives up the wall because obviously people haven't heard of long-term capital management, and they were selling the fact that all these PhDs and Nobel laureates as well. Wow. Oh, be still my heart. All right, so let's dive into this a little bit. So I'd imagine what this guy and many, many others are thinking is because as interest rates go up with inflation, the bond market will get killed. Fixed index annuities give you a guaranteed 0% rate of return when the markets go down. I get that, what I'm saying. So he's saying, look, 6% rate of return is better than 8% if 8% is volatile and 6% is essentially fixed with no downside risk. And I agree with that 100% as well. I don't have any qualm with that. But then the question is, okay, well, the bonds actually lead to that kind of volatility? Is there any evidence of that? So what we're going to do is we're going to look at the actual data, because I find the data gets overlooked a lot. So what we're going to do is we're going to go to my man Dan Coolbert's 55e.co website, and we're going to use his bucket strategy thing with his spreadsheet, which I flip and love. And we're gonna let's just go to the 10-year Treasury here. All right, and we'll use we'll even go to Treasury bills. All right, so we're gonna go to the 10-year Treasury, and we're gonna go back we're gonna start in 1968. And the reason we're starting in 1968 because this is inflation. It's at 4.2. So between 1968 and 1974, inflation went from 4.2 to 11%. So that's about a 250% increase in inflation. Pretty drastic, shall we agree? Interest rates also went from 5.5 to 7.5. So interest rates increased by 200 basis points divided by 5.5, 36% as well. All right, so this is the 10-year Treasury. This is inflation. Inflation went from 4.2 to 11. Interest rates went from 5.5 to 7.7%. All right. So we're all in agreement that the interest rates are going up. Were we not? Yes, we are. So the point being is that everyone's saying as interest rates go up because inflation is high, the bond market will get crunched. I take complete issue with that whole philosophy. All right, because what they're going to say, not this guy Tony, I'm just saying what the typical person says is that as inflation kicks in, the way you beat inflation is by raising interest rates. And I said, really? What's the evidence of that? And they're all going to say Paul Volcker. All of them are going to say Paul Volcker. I said, interesting. Because Paul Volcker, and he was the chairman of the Federal Reserve, he had raised interest rates to whip inflation now. And so the issue is that he raised interest rates so much that it destroyed the economy for a pretty deep recession, the worst recession since the Great Depression, and that put the economy on its back and then beat inflation once and for all. I said, really? So interest rates increasing is what led to the killing of inflation, is it? Okay, well, that's interesting, because if that were true, so remember, 4.2 is inflation, 11% is inflation, 5.5 is interest rates, the following year is 7.5, and yet inflation isn't going away. 9.1, inflation is still high, 5.8, 7.6, 6.5, 7.6. Now we got interest rates at 8%. So interest rates are 5.5 here at 8% now in 1978, and now inflation is at 7.6. All right, the following year, inflation is at 11.4 after they raised the interest rates from 7.2 to 8. Now interest rates are at 9.1. What happened to inflation? Oh, it's at 13.5. The following year, interest rates are at 10.8. Here's everyone's thing, 1982. So interest rates, inflation at 10.3. Interest rates at 12.6. So when does it kill inflation? When does high interest rates kill inflation? Because high interest rates, 5.5, 7, 7.5, that didn't kill inflation. 9, 10, 12, that didn't kill inflation. 14.6, that killed inflation. All of a sudden, out of nowhere, finally, high interest rates killed inflation. We only have one evidence of this in history. And this isn't evidence. This is just somewhat of I would say, a lousy correlation, because interest rates went from 5.5 to freaking 10, and inflation was still at 13.5. It did not kill inflation. We have reasons to say what happened is that they opened up the economy. And I've talked about this before. They got rid of all kinds of regulations on trucking. They got rid of fixed fares on planes. They got rid of stock commissions that are fixed. All kinds. They opened it. Carter opened it up without question. They opened up the economy. We were able to get cheaper energy, and that led to a huge increase. And never mind just globalism, not gonna lie to you, but lots of difference had nothing to do with interest rates killing the economy or killing inflation. Nothing. So, but even if so, I just want to say that. So the idea that because inflation is here, they're gonna raise interest rates, I completely take issue with that. And then the data actually was overwhelming on my side of this too, because if that were true, and inflation is here, I say, well, why then, if we look at the 10-year treasury right now, why then, my friends, is a 10-year treasury, look at this. We're going to look at 6 months. And that is the yield on the 10-year treasury. And notice the yield right here on the 10-year treasury has gone down pretty significantly. Can you see that? It's gone down from 1.6, that's it, actually, it's gone down from 1.667 to 1.42. So it's gone down by 25 basis points, while inflation is rearing its ugly head like we haven't seen since 2008. So explain that, shall we? Let me get my dog. There we go. So if everyone is worried about inflation and interest rates are being hiked, why would the yields on the 10-year treasury drop so much? Yields go opposite of price. That means the price has gone up. That means people are buying these bonds. Why would they do that if the inflation rates are so high that interest rates are going to go up, thus killing bonds? It makes no sense. And then we look at the 30-year treasury. This is locking your interest. I mean, look at this. Look at that. It's at 1.7877. Actually, 1.769. That's a 30-year treasury right now. 1.769. Who's going to lock in a 30-year bond at 1.769 if they think this is going to happen right here? The interest rates are going up, because you'll get smoked. You're going to get smoked. No one's going to do that. And but the federal government's buying the bonds. They're telling us they're getting out of it. So who's doing this? Well, people are saying, I'm going to protect my downside. So anyway, the point being is the idea that bonds are going to get smoked. Now, what will get smoked is fixed bond. If you buy a 30-year or 10-year and interest rates do go up, you are going to get smoked. But the issue is, where is the evidence that interest rates are going to go up? Where is it? Just show it to me. Because we can see in Japan it's deflationary. All right, so deflationary, no interest rates going up there, right? And then we see in America as inflationary, interest rates went up. It's almost like Interest rates did not kill inflation. It didn't. What killed inflation was open the economy. So they're going to horrible. We're going to have high energy costs. That's going to make inflation. Or they can raise interest rates all they want. But don't forget, how much debt did the federal government had in 1960s and 70s compared to what we have now? Yeah, exactly. If we raise interest rates, the biggest line item in our portfolio for our federal government budget will be the payment of interest. We don't have the cash to do that, my friends. It isn't there. I am not worried in the least of high interest rates. I'm not. And you shouldn't too. I certainly could be wrong. But the idea I'm going to trade in my bonds for a freaking fixed index annuity? It's crazy. All right, so let me show you something else here too. And I've done this a million times on Sunday, but we're going to look at the Putnam Income Fund. This is the longest bond fund, pure bond fund I know of that goes back to 1955. Not a great fund, not a bad fund, just been around. I just like the fact it's got longevity. All right. So in 1969, it was down by 18% after the previous 2 years up 15 and 14. So what happened in interest rates in 1967, 68, and 69? I don't have 67 up here. Let's go to 1967. This is a 10-year, and we'll just go to 1966. All right. So in 1966, the interest rates, the 10-year Treasury was 4.6, 4.6, and 5.5. All right. So in 1969, it went from 4.6 just 2 years previous to 6%. So in 1969, the bond got smoked. It was down 18% from just a tiny little increase in interest rates from 5.5 to 6, or even going to say 4.6 to 6. All right. So 1969 got smoked. All right, so now we see interest rates going from 6 to 7.8 in 1970. What happened? 1970, even though interest rates went from 6 to 7.8, was up to 7.67%. It recouped a lot of this loss right here. Interesting. So then we're going to start seeing when interest rates really start going up, 1974 through 1980, right there, 85. 1974 through 1985. So remember, here's high interest rates. High interest rates. When did inflation get killed? Right here. But yet we still have high interest rates. And now the economy's booming, by the way. 1983 and 84, the economy's booming. So the high interest rates to kill the economy, to slow inflation, it's silly, man. You're being fed a freaking pile of Finney's stew, if you know what I'm talking about. Look at this. Hot 10. Over 10, double digits for 6 years running, double digits. 9 or over 10 for 8 years running. Didn't kill the economy. The high interest rates did not kill inflation. The growth of the economy grew the economy. And that actually killed inflation. It wasn't the interest rates. All right, so anyway, let's go back. We're going to say from 1974 through 1986. Well, let's go to 1982 because that's when the interest rates started going down. From 1974 to 1982, when interest rates were going up double from 7% to 14.6. 1974 to 1982, what did this fixed income fund do? It was down 7.47, up 17, up 20, up 5, up 2, down, basically break even, down, and then up 8. Is that a significant decline in your portfolio as interest rates fell? No, it's not. As interest rates went up, no, you didn't get smoked. You didn't. Now, are you going to get smoked now? No. You could. I don't know. Is there any room for it to go up that much? No. Your bond fund isn't going to pay you much money. I'm just telling you right now. There's no money to be had in bonds. That doesn't mean you turn around to fixed index annuities and lock up your money for 15 years. Give me a break. The point about the bonds is liquidity, to give you that cushion. I don't like this idea at all. I'm not a big fan of these fixed index annuities. The idea that replace bonds, but I mean, the point being is liquidity is king, and the bonds give you liquidity. And if you have a good bond fund of lower, shorter term investments, not long maturities and stuff, yes, you will have some down years. I mean, if you look at Ginnie Mae, it's had 3 down years. 3. Wow. The worst was like 2.33. I'm not saying that's going to happen again. I have no idea. Are you making much money? No. But are you going to replace your bond portfolio with a fixed index annuity to goose returns? No. Now, I hope this makes sense. Don't be so nervous about bonds. It's just not. I just don't. I want to see some evidence that raising interest rates beats inflation. There isn't any. I'm just telling you right now. All right, love to hear your thoughts. See you.